All right, let's jump right into this explainer. If you've ever strolled down the premium beverage aisle, you've definitely seen Suja's brightly colored cold-pressed juices. You know the ones, promising health, vitality, and total transparency right there on the bottle. Well, today, we're going to treat Suja Life's Q1 2026 SEC Form 10Q exactly like one of those nutrition labels. We're peeling back the packaging to demystify their recent leap into the public markets, and trust me, we're going to find out what's actually inside the financial makeup of this company.
To keep things moving, here's our game plan. First, the Suja Life IPO. Second, squeezing out a profit. Third, risks inside the bottle. And wrapping up with reading the fine print.
Starting off with Section 1, the Suja Life IPO, or the bold claims on the front of the bottle. Let's get into the big, flashy event that triggered this whole filing.
This is the exact moment a private brand steps into the unforgiving light of the public markets. The actual document we're decoding today was filed just weeks after their May 8, 2026 IPO on the NASDAQ exchange. For retail investors and analysts, this Form 10Q is literally the ultimate source of truth. It cuts right through the slick marketing spin and lays bare the raw, unfiltered numbers of a newly minted public entity.
And wow, the scale of this market debut is just massive. The IPO generated a cool $186.7 million in gross proceeds, offering up over 8.8 million shares of Class A common stock at $21 a pop. I mean, for a cold-pressed juice and wellness shot company, raking in nearly $200 million is a monumental statement of market confidence.
But here's where it gets really interesting. Where did that mountain of cash actually go? If you assumed it was all being pumped directly into shiny new factories or, I don't know, exotic new juice flavors, well, think again. They heavily prioritized scrubbing the balance sheet clean. A staggering $142.6 million went straight to repaying outstanding debt from an old 2021 credit agreement. On top of that, $17.5 million went to employees, mostly settling vesting units and paying out celebratory transaction bonuses. Add in roughly $15 million in IPO expenses, and you quickly realize the vast majority of this IPO money was used to settle the past rather than exclusively funding the future. Moving right along to Section 2, squeezing out a profit, the macro ingredients. Let's look at the financial fundamentals that gave Suja all this momentum. Why did the market buy in at $21 a share? Well, the answer is in their top-line growth. Looking at their momentum going into the IPO, Q1 2026 net sales skyrocketed to $107 million. That's a huge leap up from $87.3 million in the exact same quarter the previous year. That kind of double-digit revenue growth, especially in the cutthroat food and beverage sector, is exactly the sweet metric institutional investors are hunting for. And this next point completely flips the script on their bottom line. Look, it's one thing to grow sales, it's an entirely different beast to actually achieve true profitability. Suja went from a net loss of $792,000 in Q1 of 2025 straight into a very healthy, very robust $7.7 million net profit for Q1 of 2026. This proves they aren't just pushing more juice out the door, they are actually retaining the margin on it. Of course, producing fresh, highly perishable products is incredibly expensive. Selling more juice inevitably means higher logistics costs, and Suja reported that outbound freight, shipping, and handling jumped to $6.84 million for just that one quarter. When your product literally has to be kept ice cold and moved fast before it spoils, your logistics network is your lifeline. But it's also a constant heavy weight on your operating expenses.
All right, Section 3, risks inside the bottle. Time to flip the label around and read the warnings.
Every 10Q comes with a list of risk factors, and for a fresh beverage company, these vulnerabilities are very, very physical. They're exposed on multiple fronts. We're talking limited organic fruits, volatile pricing from a tiny pool of packaging suppliers, and a heavy reliance on centralized production. Honestly, any major disruption to their primary facility in Oceanside, California would be catastrophic for output. Throw in the constant looming threat of an economic downturn because, let's face it, a premium cold-pressed juice is absolutely a discretionary purchase for consumers.
But beyond the physical stuff, their customer concentration is what's particularly striking. A single buyer, mysteriously identified only as Customer A, accounted for a massive 33% of their total net sales. That translates to nearly $35 million coming from one single source in just 3 months. While it's fantastic to have a retail partner moving that much volume, it creates a terrifying single point of failure. If customer A decides to, say, reshuffle their shelf space, Suja's revenue takes an immediate nosedive.
The filing spells out exactly how the company legally frames these existential threats to their supply chain. They are literally at the mercy of the weather, farming yields, and global logistics. A bad harvest season for one specific organic vegetable isn't just a minor headache, it directly threatens their ability to manufacture their core products and ultimately protect those hard-won profit margins.
Finally, Section 4, Reading the Fine Print. Let's dig into the corporate structure.
This is where the mechanics of public ownership get fascinating and, honestly, a little convoluted. We absolutely have to talk about the Tax Receivable Agreement, or TRA. Retail investors need to understand how this works. Essentially, as the newly public company realizes certain future tax savings, 85% of that cash isn't kept in-house to reinvest or pay out to everyday shareholders. Nope, it gets funneled right back to the original pre-IPO owners. It's a super common private equity maneuver, but it essentially means a massive chunk of future value completely bypasses the new public investors.
We also have a dual-class stock structure at play, which is absolutely vital to understand. Everyday public shareholders buy Class A stock, one vote, full economic rights, pretty standard. But the early insiders, they hold a special Class V stock. This grants them 38.4% of the total voting power of the entire company, despite having absolutely zero economic rights attached to those specific shares. It's basically a structural lever custom-built to maintain heavy influence over the company's direction.
Which leads us directly to a very explicit risk factor. The 10Q neutrally but firmly points out that Suja is ultimately controlled by the private equity firm Payne Schwartz Partners, or PSP. The document explicitly warns that PSP's interests might conflict with those of new public shareholders down the road. You know, when a single entity holds that much sway, their exit strategy or operational preferences are always going to take the steering wheel.
So, what's the big takeaway from this explainer? An IPO is never just about selling a great product. It's about the complex financial engineering behind the scenes. Suja absolutely has the recipe for massive sales growth and impressive new profitability. But I'm going to leave you with this final thought to ponder. Does this complex corporate structure, complete with its tax receivable agreement and heavy private equity control, leave a sour taste for new public investors? That's a question you're going to have to answer for yourself the next time you read the label. Thanks for hanging out and diving into this with me.